and welcome to today's installment of Merrill Corporation's ongoing webinar series entitled Executing Effective M&A, Opportunities in Technology. My name is Richard Martin. I'm a Senior Director here at Merrill Corporation and will serve as your moderator today. With the advent of cloud computing, many providers of legacy technology face challenges as they work to adopt to a more agile subscription business model. This is especially important today as companies with subscription business models offer investors far richer valuation multiples. Add to this the reality that macroeconomic conditions, based on a decade of low interest rates, strong credit markets, and cheap debt, are favorable. So when you mix these factors together, difficult to change business models, a high valuation on recurring revenues, and favorable macroeconomic conditions, many company boards have chosen to pursue funding for acquisitions by an injection of private equity or venture capital money rather than the more traditional public funding mechanisms. So like a tale of two cities, this is a tale of two tech M&A marketplaces that have emerged, primarily based on the size of the deal. So a current example is the announcement last month of Centerbridge Partners, a mega-sized private equity firm with $14 billion under management. They closed on a $1.3 billion purchase of food services equipment distributor TriMark USA. Now, our recent examination of technology activity reveals some very interesting patterns. The tech market today is far different than that of the dot-com days. Back then, companies went public or were sold despite having little or no revenue, or even a working business model. The landscape is so far different today, where companies have tested business models, generate revenues, and most importantly, are profitable. Now, interestingly, investment banking remains strong in the larger deal space, but in the first quarter of this year, over 20% of all private equity deals involve companies in the IT sector, and we'll discuss that a bit further. And that's above the normal 10 to 15% range we've seen for the past decade. It also appears to be the case that tech founders to exit via IPO is no longer in vogue. Just 5% of U.S. venture-backed exits last year happened via IPO, which is down from a high of about 12% historically. So the market is changing substantially. A number of questions have arisen as a result. What's driving tech M&A? What's driving technology company valuations? How corporations are funding entry into new industries? And will the reshaping of the industry lead to a wave of spin-offs in the next few years? So today we've assembled a panel of esteemed experts to draw from their expertise and offer their pertinent insights on opportunities in the tech sector. Before I begin, I'd like to just take care of a couple housekeeping notes. One, if you have questions, please send them via chat. We are monitoring, and we'll make sure that we address your questions or whatever. The Q&A will come at the end, and we will address questions from that point as time permits, but we will certainly send you a webinar replay and the slide deck within 48 hours of the webinar. So let's begin. I'd like to first introduce our speakers. Our first panelist is Veena Abadhanam, who is a deal lead in the corporate development group at NetApp and has over 15 years of experience in strategic, operational, and advisory roles in the technology industry. Our next speaker is Roger Spitz, who is a managing director and head of the TMT and West Coast M&A at BNP Paribas. He has over 15 years of experience in the industry as well. And finally, our last panelist is Gary Galba, who is the president of Advanced Solutions Group and the chief enterprise relationship officer with over 20 years of experience as a senior managing executive and advisor. So we have a great panel ready to discuss some pretty interesting topics. And I'd like to kick off by first just reviewing a few bits of information around the market and the sector, sort of set the stage for what we're talking about. To begin with, I'd just like to note that technology M&A remains sort of the number one sector in terms of activity currently. It has been so for quite some time, for the past several quarters, and some of the biggest deals are coming out of this sector. I'd like to also note that in terms of valuation, it's very similar. High-tech deals and technology deals are the second most active in terms of valuation. And so the point being that with over $196 billion in activity, there's a lot going on in the technology space. But I think before we get into the details of our conversation, was one topic that I'd like to address with our panelists, and that really comes down to is how do we define a technology company? I've intentionally put up a few things here to stimulate some conversation, but I think, Gary, I'd like to start with you and get your perspective on what makes a technology company. I mean, the term is used frequently, It may have lost some of its meaning because technology is everywhere, but let's just make sure that we're all on the same page. So Gary, how do you define technology company? And Veena and Roger, please chime in.
No, thank you. Thank you, Rich. It depends on who you ask, right? Even a brick-and-mortar company will tell you today that they are a technology company. Every enterprise knows that if they do not transform towards a technology company, they will be extinct. So, if I look at the names out here, Macy's, right, we would say it's a brick-and-mortar retail store. But look at what they're doing on the Macy's.com, and that business model is going to transform totally towards e-commerce, and they're going to be leveraging technology to the hilt. Every single company, in my opinion, would be categorizing themselves as a technology company. Are they there today? No, but they are moving towards that path. In fact, the term we used to do, IT, it'll not be called IT anymore. It'll be called business technology, because every business, how is going to evolve towards driving the top line, increasing their bottom line, mitigating their risk, will be relying on technology like no tomorrow. I could keep going, but Richard, hopefully that was a good sound bite to get things kicked off.
Absolutely. I'd love Veena to give her perspective as well. We had a lively debate around this last night. So, Veena, what are your thoughts?
It was an interesting discussion yesterday, and this topic is always kind of an interesting one to consider. It's hard to classify companies because, like Gary pointed out, most of them would call themselves a technology company. But I guess as far as I'm concerned, I kind of say, okay, most companies today do depend on technology to stay afloat, but does that make them a technology company? I think it's, to me, a technology company is one which has technology as a core competency, in the sense, do they need in-house technical innovation to thrive, or are they able to just be consumers of technology and leverage it to run their business or transform their business? Because that is right. Gary's absolutely right. Everybody is going to do that, is going to have to do that if they're not already. But to me, the question that differentiates the technology and non-technology businesses going forward is, are they producers of new technology or merely consumers?
Thanks, Veena. And Roger, not to put you on the spot, but you gave, I think, an interesting final perspective about the usefulness of the description at all, given both of those factors. Would you mind repeating that?
Sure. I mean, it's an interesting debate today where the lines are still blurred. But I think from my perspective, I'm not sure whether they'll really be able to make such a distinction tomorrow, though. I think it's not so much around technology per se, which defines a company, but I think it's the digitalization of the industries and the new business models which are emerging, and effectively which companies successfully achieve that digital transformation. So as we look to the future, I think it will be difficult, in a sense, said differently, to be a non-technology company, given what is happening to the new world.
Thanks, Roger.
So, Rich, can I add one more soundbite out here?
Absolutely. Please.
I think you kind of stirred up my thought process looking at Amazon and Whole Foods, right? We all just saw the Amazon acquired Whole Foods. And, that gives you a powerful indication that the way the entire food ecosystem is going to change in a big way. And I use the term food tech, which will be major disruption in the food world. The Whole Food stores would not exist the way they're today, because everything is going to move towards the e-commerce play. And especially if you look at some of these cloud providers, right, whether it's Amazon or Microsoft or Google, right, they are really powering up the application workloads for various businesses to truly move towards being a technology company. So just wanted to add those sound bites.
Thanks, Gary. I think the point of this is that it's a very interesting conversation, and the takeaway is that labels may not matter so much, given that every company has to leverage technology to create differentiation. And I'm quoting Gary, but otherwise they will be left behind. And so as a result, it makes every company, if not a tech company, certainly a utilizer of technology, and it's a certainly important element to their business models. So I just wanted to set the stage for that. I'd like to turn now and just get some involvement from the audience and give you an opportunity to participate. Throughout the presentation, we have a few questions. The first question is, what do you expect to have the greatest impact on M&A in the technology sector over the next 12 months? And we have some multiple choice options here. Please take about 45 seconds or a minute or so to register your answers. And so far, we're seeing a pretty broad mix. Liquidity leads the way. About a third of our respondents are suggesting liquidity will have the greatest impact, followed by tax reform and then the repatriation of offshore earnings. I think the point is that the conversations happening today around tax reform, around our economic reform, and our trading partners is something that is instrumental to our thoughts about the future. Did anything surprise you, Veena, Roger, or Gary in the results here? And we'll just take about another 10 seconds or so to finish up the answers. Okay. We will also share this information with you at the end of the webinar. The vast majority of our panel, of our participants rather, see the excess liquidity as being the thing that will have the greatest market in technology. So, interesting information. Moving on now, we'd like to give our panelists an opportunity to share their perspectives on a number of ideas. So, Veena, if we start with you, can you start talking about the changing landscape of IT infrastructure?
Sure. Thanks, Richard. So I think this ties up almost perfectly with what Gary was saying in response to the last question about how the cloud companies are kind of coming in and changing the way IT itself is done. Excuse me. Cloud as a platform is definitely the overarching theme in the technology landscape today, and it's rapidly growing in market share and also customer mind share. And this is fueled by new developments and adaptations like digital transformation and the device explosion happening in the consumer space. Coming back to enterprises, I think they continue their migration from private to public clouds as their previous concerns about security and control as being eased by new developments. However, we've seen that data is also having to be brought on-prem because of some issues that are either regulatory concerns or cost optimization or just probably failure of data security or a breach in that. So data movement is a key consideration in the IT landscape today, which wasn't the case some time back. Seamless migration between public and private clouds. And when I say private cloud, it's either a data center or a private cloud facilitated by a third party, like a web hosting provider. So as cloud and on-prem battle for dominance, the relationship between the various players in this large IT infrastructure space is getting quite complex. For example, HP and Dell, are they partners or competitors to the cloud hyperscalers? That just depends on which day you're talking to whom, and these relationships are changing and dynamic. Lastly, software-defined infrastructure has become the key pivotal point these days as hardware is getting commoditized. And services are becoming key to differentiation for most of these IT providers. In summary, I would say that customers are gravitating to hyperscalers and other cloud providers, and the traditional infrastructure players are facing tremendous pressure to reinvent themselves for a cloud world. And this is basically, in a nutshell, what's happening in the IT infrastructure space. Thank you.
Thank you, Veena. Excellent. Roger, you're up next. I'm going to ask you to give a perspective on the disruption that's driving technology across industries.
Sure. That's an interesting one, Rich. And I think, as we debated a moment ago with Veena and Gary, today no one is really immune from technology disruption. No company, no sector. So effectively, what you're seeing is you have traditional companies which don't necessarily have software or internet in their DNA, which are having to make sizable acquisitions in technology, from Walmart to Unilever, GM, etc. So what you're seeing is that as the pace of innovation is quickening, companies are more readily outsourcing R&D and innovation to the market through M&A and investments. Anecdotally, 2016, I think, saw the first time where non-tech industry players acquired more 1 billion plus startups than technology buyers. And you're seeing that every day, not least, I think, a week or two ago, when the John Deere tractors company announced the acquisition of Blue River for $300 million, which was effectively a machine learning, technology company to help them increase the capabilities around its farm equipment and reduce, herbicides and know where the weeds are present, and optimizing effectively, the use of data inputs in farming. So this is what you're finding across all the industries, and it does feed M&A because in a way it accelerates the cycle rather than sort of doing everything in-house.
Excellent. Thank you, Roger. And next, Gary, I'd like you to talk a little bit about the connected world and how companies are transforming as a result.
Absolutely, Rich. Guys, what I would say, we are in a very interesting era and the decade. The next 10 years would be absolutely dictated by the new connected world revolution. You're looking at 1.8 trillion connected objects by year 2020, generating 43 zettabytes of data. And just curious if anybody knows how many zeros in a zettabyte. Maybe I can ask my co-panelists out here. Just as the number of zeros are amazing. Reena, you want to take a cut at how many zeros in a zettabyte?
Thanks for the cold call, Gary. I mean, for me to work that out will take more time than we should be spending on it. But yes, that's a lot of zeros.
Roger, you want to take a guess?
I have the same answer as Veena. I think we're aligned.
Okay. So guys, 1.8 trillion connected objects by year 2020, generating 43 zettabytes of data. Each zettabyte is 21 zeros. And this amount of data will continue to explode and will continue to challenge our thinking in terms of how we need to transform our companies and help drive shareholder value and also create more deeper insights. You saw recently CenturyLink had announced the acquisition of Level 3. It was a pretty massive $34 billion acquisition. And our philosophy, network is going to be in the core of this entire revolution. Now, CenturyLink would have 750,000 miles of fiber touching 100 countries over 6 continents, with 40% of the global internet traffic going through our network. Without a reliable network, the connected world would be a big, complex problem. Now, with this connected world, other key issue which kicks in is around cybersecurity. Because if you don't secure each of these objects at the object level, you are leaving the door open for the bad guys to enter, and it will be like a wild, wild west. So that piece is going to become equally important. And there's a new term you will all start hearing, deep tech. Now with the blockchain, right, and obviously the entire cryptocurrency, which we've been hearing about, is leveraging blockchain on the hilt, and that's is going to have a major impact on how the technology will evolve. And the new term is going to be the deep tech platform, which will be combining the blockchain, the machine learning AI, the cybersecurity in this new connected world. And these topics are absolutely the critical topics in every boardroom and majority of the bigger corporations, how they adapt to the changing environment. So this goes back to the Darwin theory, adapt, evolve, and thrive. If they don't, they will be extinct over the next 5 years. So connected world is going to bring a lot of great opportunities, but it would also create a lot of challenges. Rich, back to you.
Thank you, Gary. I'd like to go into the next question for our audience, and this is a little bit of a shift, but I think it's relevant at least to the examples that Gary just provided on a huge deal, and I mentioned the other deal as well as we've seen a lot last year, Apollo buying Rackspace, et cetera. So the question is, what effect has private equity had on technology M&A? I'd like to give you guys about a minute or so to answer. What I like immediately, and Gary, Avina, and Roger, maybe you comment, is the huge positivity we're seeing from our audience. There's an expectation that there'll be an increase in valuation, an increase in volume. I think it makes sense. I can say that from Merrill's perspective, looking at our internal data, we're seeing more private equity fundraising projects and such, and so and we've seen a lot of activity in healthcare across industries. So this makes sense. Would you agree, Roger, Gary, Avina, that this is a sensible view?
I'm a little bit surprised because I usually think that strategics tend to pay more than private equity buyers who tend to kind of scrimp on the valuation. So I would have thought it would increase volume, however, decrease the valuation, especially for companies that don't have strategic buyers.
Yeah, but at the same time, it depends on the sector they're going after, especially some of the emerging areas we were talking about. They would be willing to pay high valuation, and my third venture, which I built, was a similar example. The PE companies are willing to pay a much higher valuation, but I decided to go the CenturyLink route because of the other synergies and the elements. It really boils down to the segment of the sector and the technology, which will be causing major disruption.
I'll just take 1 minute to address that. So two things here, right? One, company founders and CEOs probably want to keep their job and think that long-term a company that they think is a strategic fit is a good home for themselves. That's one dynamic that's not to be considered. But what I was talking about was private equity acting in an industry where there are too many buyers. When there are many buyers, if a private equity is buying a smaller company, it's usually to strengthen their portfolio, in which case they're really behaving more like strategics than private equity. So I would still tend to hold that strategic buyers would usually pay more for any company than a private equity player would, but that's just the way I see it.
And that just, it's an interesting point, Veena, and I think a lot has to do with the must-have versus nice-to-have, I guess. And yourself, you're strategic, so you probably have a better view certainly than me, just as an advisor. But I think there are situations when it's a must-have and when it's compelling and there's specific technology involved, then there's no choice. The strategic has to do it. He's prepared to pay any price, and often there'll be synergies, etc. When it's a nice business, they're good margins, it's maybe more defensive, like some of the payment processor deals and all that, PEs love it. But are any of these an absolute must-have, or is it just getting a bit more market share or what have you? Then I guess it can be it can go either way, maybe. Maybe that's a differentiation.
That's a good point, yeah.
Excellent. Thank you. As you can see, there's robust discussion around the topic, so I think this is excellent. We're going to move into the section now on individual questions. So to start, let's start with our question about the reshaping of the industry. And Roger, this one I think we'll start with you. Will the reshaping of the industry lead to a wave of spin-offs, in your opinion, over the next 5 to 7 years? In relation to typical funding cycles or not?
Sure. So, personally, I'm not sure that we're in a typical prescribed cycle as such, but I do see a major wave of spin-offs, and I do see this sort of feeding the market and M&A deals. I would sort of separate the strategic industry players with the funds and the financial players. I think on the strategics, I observe a number of elements. I think, first of all, is that across all sectors which are successfully transforming themselves into becoming leading companies, effectively they're gradually morphing into new business models. And this means that there's a dominant proportion of the value which is likely to be around technology capabilities. To do that, what's happening is the companies that will succeed, they're continuing to develop these new models, either through R&D or through M&A. And the important thing in terms of as they transform as they go through that journey, they're divesting certain legacy activities, sometimes pretty sizable, which don't immediately contribute to their overriding strategy. So, for instance, Visteon, as it moved from an auto supplier to technology player in an auto vertical, it basically sold a number of activities, its interiors, air conditioning, lighting, etc. Or if you take Siemens, which it sees itself as a digital software company tomorrow, which is taking on for its leadership team or chairman, the former co-CEO of SAP, effectively again announced this week the rail JV with Alstom, spin-off of healthcare in due course, sold its IT services, consumer lighting, telecom equipment. So effectively, and making huge acquisitions in software. So effectively, you're having these huge groups who are going through the transformation and will lead tomorrow, but through that are selling a lot of non-core activities, and that feeds the market with effectively spin-offs or divestments and that. And then I would say for the strategics, again, you have a second consideration, which is the companies which are investing heavily in innovation, including in some of the new disruptive areas, AI, machine learning, and other buzzwords. But effectively, some of those will break through, and some of these will build scale and leadership with new businesses to the point where potentially tomorrow they might consider spinning off some of these activities in some shape or form, but not necessarily as a sort of, I'm spinning it off because it's non-core, as we described for Visteon or Siemens, but more spinning off in terms of, it's of a scale and size and leader to maybe live its own life. And then the final comment I would make is maybe 2 minutes on the financial sponsors or the funds, as we mentioned. I think here the cycles are probably more blurred. I think there's a huge amount of funds, as we've established. Some of them are captive or corporate VCs. Some of them are other VCs or growth equity funds, regional, global Ps, but which all have different fund life profiles for their exits. They've been investing and continue to invest heavily, but at different phases of maturity. And I think for these different business models and asset types, they won't necessarily have a prescribed cycle or duration of investment, and they'll just basically, as these sort of funds exit, feed the market again with deals and spin-offs.
Thanks, Roger. Veena, what's your perspective on the same question?
Mm-hmm. I think Roger covered this in a pretty robust way. I just want to add a couple of points. Now, I absolutely agree that as like today we have so many frontiers where technology innovation is happening that at least the tech companies are definitely hard-pressed to keep a very large umbrella kind of presence. I mean, look at HP. I mean, the number of spin-offs they've gone through is legend. And the reason is, again, they find it hard to compete with focused niche players if they're not themselves focused, and that kind of forces them to break up. And also there are other factors. One is you might have a buyer interested in buying a small part of your technology that you consider legacy and more like a cash cow. So why not sell it and harness that cash right now so you can deploy it in other places, like buy a company that gets you ahead in the technology game. Or maybe there is enough conflict in the sales motion between the consumer side and the enterprise side, if there is any company that's really doing both these days. That can be a problem. So they try to spin off to kind of improve their strategic focus. And then there is also the financial incentive, right? I mean, Wall Street always values companies differently based on how innovative they're perceived to be. So companies might try to shed some legacy baggage to get that pop in their valuation also. So there are a number of factors that are influencing it. But yes, spin-offs have become very common both in the tech world and outside, I would think.
Thanks, Veena. For our next question, I kind of want to go back a little bit. We discussed that private equity is having an impact, and there's a variety of ways to look at it. It could be valuation, could be volume, could be both, or whatever, but it's having an impact. But let's talk about what's driving the valuations. And so maybe, Gary, you can start. So in this changing market landscape, what is driving technology company valuations?
Absolutely. It's always a kind of arm wrestling match, right, between the buyer and the seller, but really boils down to the industry and the supply-demand dynamics. since we were talking about the AI machine learning, in that space, there's not a whole lot of talent, quality talent which exists, and we have seen certain transactions, right, where they're really acquiring the talent, some of the big companies, and they're paying $1 million a pop because they really need the AI, machine learning, and the deep learning talent to get things moving. Then obviously, the valuations, it can be pretty subjective based on how desperate is the buyer to get into a certain segment of the market. They like what that company is doing. They like the talent. They like the leaders, and they truly believe the founders of that company can really step up based on the voids they have. And situations where you're trying to take the competition out and they're becoming a major noise, you will pay them a certain valuation to get them off the competitive landscape. But again, a lot of the companies who are truly moving towards the digital transformation and are trying to fill the gaps and clearly see that as a large company is going to take them much longer to develop and enter into those markets. They're picking up those companies at pretty healthy valuations. And again, if it is truly the critical number of users which the platform has, right, and a corporation can leverage that to rev up their sales, they will be willing to pay the valuation. So to me, it really boils down to the IP which company brings to the table, the people, and if the people would be a good cultural fit and is going to help them drive their top line. They're going to help them create a more powerful user experience and a customer value. Valuation is becomes subjective. Obviously, the pure M&A teams would go with the financials, the cash flow, the EBITDA, but it really boils down to a business decision beyond the financials of what value they're bringing to the table and spike the valuation. Back to you.
Thanks, Gary. And Roger, maybe you can add to this. I just was wondering if you think that, and you can go beyond, whether the strategics and their ability and desire to go across industries has an impact on valuation as well.
Sure. I mean, I think Gary's response in relation to the scarcity, the technology, and let's not forget a demand supply, because it's usually the best bidder pays for it, and competitive tension and scarcity is linked, are sort of some of the key drivers. I tend to sort of look at the world when it comes to valuation technology in two ways. I think some deals are very straightforward, or more straightforward, let's say. So when you look at software automation, the deals which Siemens did with Mental Graphics, when you're looking at targets which have relevant benchmarks, projections around growth, profitability, there's market data, there's these often listed companies with established models, etc. I would say that you have some data points, and that facilitates the valuation exercise. I think the real challenge is really with the disruptors, if we can call it that, with emerging models, with emerging companies. The honest answer there is that sometimes there is an element which is extraordinarily subjective in terms of how strategic it is for a particular buyer, and where the sort of more traditional drivers are more difficult to sort of rationalize effectively in terms of the value. If you take Facebook, which bought WhatsApp, I think for $19 billion, and at that time had less than or about 50 million sales with losses of $100 million. But today it's effectively how the entire world makes calls, and in less than 3 years, WhatsApp overtook the SMS market, which started pretty much 20 years ago. So in that case, the answer in terms of what drove the valuation, I guess, was one, seeing the future, which is not always easy in terms of how pervasive it can become if you get it right, and what it means for reaching billions daily and how sticky they are across platforms. and then the user growth and to a degree the defensive play possibly against a Google or others making the same move. So when Facebook did that acquisition, I think its market cap was about 160 billion versus 500 billion today. So it's not the only reason, but I guess it's doing some things quite right.
Thanks, Roger. Our next slide is a question for the audience, and I'd just like to get a sense of your expectations for M&A activity, really in the short term. We typically ask for 12 to 18 months out. I'm curious to know what your expectations are for tech M&A activity in the next 2 quarters. And we'll take about 45 seconds or so or a minute to answer, collect responses. I think positively for us all, we at least think there's going to be some activity, modest or not. At least there's going to be an impact, and I think that activity will continue. Okay, Linda, why don't we give it another 10, 15 seconds or so for people to respond. So I think what we're seeing is that there's the majority of our audience, and this reflects some of the data that we've seen externally as well, believe that there will be additional activity. Candidly, from Merrill's perspective, we see projects and deals usually about 180 days or so before they become announced in the public, and candidly, the increase in activity we're seeing reflects this information. So I think this is about right. Moving on to our next question, Veena, I'd like to come back to you and talk a little bit about how companies are using venture funds to de-risk their entry into new industries. Is this affecting the investment banking sector, and how does that compare to the days of the tech bubble years ago?
Corporate VC is an interesting animal, right? I mean, it's picked up a lot of speed. 10, 20 years back, there were very few companies that were actively doing it. These days, everybody has a corporate venture arm. I recently learned that even 7-Eleven has set up a corporate venture arm. So it's an interesting dynamic. I mean, it seems like a straightforward conclusion that corporate VCs invest mainly because they want to lock in a right to buy the company in the future. So you would expect a lot of that happening. But the statistics kind of show otherwise. Most of the active corporate VCs buy only a tiny portion of their portfolio. I mean, Intel Capital, it's like one of the most active corporate VCs that have been doing this for a very long time. They kind of created the space, if you will. But even them, they have over 200 exits in their portfolio, but only 12 of those were acquired by Intel. And they are kind of the leaders in at least acquiring their own portfolio companies. If you look at Cisco, they seem to be a different story. Even though they're an extremely active investor, they seem to be buying companies that are kind of invested in by other corporate VCs rather than themselves. So the fact is that CVCs invest mainly for learning about a new market or technology that they think might become important to their core business at some point. This is a great way for them to learn about the portfolio companies, but more importantly, the space the portfolio company is playing in, the competitors, and the implications for the corporation's own core business. So yes, CVC is definitely more a vehicle for exploration for these corporations. And sometimes they do return a good return on investment, which is always a bonus. But the impetus is really always to learn more about what's happening at the fringes of what their own technology is currently focused on, but also at the forefront of it. Where are things headed to?
Thanks, Veena. And Gary, I like your perspective also, and maybe in doing so, you could also comment on the fact that how things are different today, because during the tech bubble, a lot of corporate funds were established but didn't stick around very long. So how do companies achieve that longevity of funding that they need to grow?
Well, thank you, Richard. Veena articulated things really well, but just to add some of the comments, at the end of the day, as we articulated earlier, innovation is moving at a very rapid pace. And I know this year at the World Economic Forum, Jack Ma had made a comment, right? You got to really pay attention to the 26-year-olds, the kind of companies they are creating and driving. And it's a very important point because as the company gets larger, your focus, and they are publicly traded companies, you have to deeply focus on delivering the quarters. The cash flow becomes very critical, and it always becomes a complex decision. Okay, how much do we want to build ourselves versus invest in companies and kind of mitigate your risk or hedge your bet, so to say. And to me, this is a very powerful way to de-risk being left behind. And you are betting on some of the innovations. And to your example, Roger, on WhatsApp, right? What Facebook did, they could see the future in terms of how it's going to transform the marketplace. And I think, to me, that's a critical role which the corp dev teams have to play on the future emerging technologies and de-risk being left behind.
Thank you, Gary. Our next question, and Roger, I want to start with you, and this kind of goes back to the beginning of the conversation where we talked about what is a technology company, and really the definition isn't as important as the fact that technology is across industries, and it's important. So, Roger, what challenges have you observed in progressing cross-industry type deals, and how have you approached the early due diligence stages of those kinds of deals?
Sure. So, no, it's a good one. And again, speaking as an intermediary, as an advisor, rather than as principal. But as that casual observer, where we work with our clients on these sort of transactions, often, as you mentioned, which are across industries, looking at technology, I think the first level is really the validation of the strategic rationale and having an internal sponsor. Often these can be new activities, or you're looking across an organization with several different teams, and you need to establish who is a sponsor, where's the expertise, and where will the target ultimately lodge. It might seem like a little bit of a nebulous point, but I can assure you that in the concrete world, with different groups, large organizations, huge specializations, and that is a very important point around the rationale and the internal sponsor and the organization. I think the second challenge is, we talked about it earlier, the valuation. I mean, it's usually an issue, especially with some of the higher growth, more disruptive plays where you can't necessarily, build the standard model or have certain contained benchmarks. So without these concrete synergies, without necessarily any data points, and with new emerging models, valuation is invariably going to be in a complicated area. I would say the penultimate point in my mind is probably around integration and culture to effectively maintain the innovation. I think innovation was mentioned pretty much, every few words in our discussion. It's absolutely key to everything that we're talking about and to the way the industry is moving. So effectively, that has an impact on the structuring, the integration culture to maintain that innovation. Do you do a JV? Do you manage standalone? Do you integrate it fully? Do you do an investment, control it, etc.? And then the final point, and apologies for coming back to this, but it's the sort of the lack of the crystal ball. Which technologies will ultimately be pervasive? Where is the industry going? What position in the value chain are you going to have in an industry that isn't yet defined? And I think that's where one sort of draws a line between visionaries and others. It's less challenging if you're a visionary and you can see that clearly and convince your stakeholders than if you don't have that clear vision of the future, unfortunately.
Sure, that makes sense. Thanks, Roger. And Gary, just to reference back to your point earlier, you just completed a series of substantially significant acquisitions and mergers and such. Could you comment on the same question? How did you progress those deals, and what were some of the challenges that you saw and were able to resolve?
Roger did a great job, but to me, having personally built 3 companies and sold those companies to the larger entities, to me, beyond the valuations, right? Once you agree on the valuations, it's the most important element is a cultural fit and the chemistry with the leadership team. Those are super critical elements because if there's not a good chemistry or cultural fit, you will pretty much kill the acquisition and the reason you're acquiring them. And to me, that needs to be the number one element beyond the valuation of how good of a cultural fit it is. Then beyond that, the second element is, okay, the reason you're acquiring a company, they are disrupting the marketplace, and you do not want to curb that disruption as you become part of a large corporate organization where there can be a lot of process and it can kill the innovation cells, I would say. So you need to be careful to integrate in a way where you're not killing the speed and the way the out-of-the-box thinking the team is looking at. And obviously looking at, okay, how do they leverage the broader organization to drive the shareholder value. Now, I'm giving a broader view just in terms of what I feel are the important elements. And specifically to some of the acquisitions CenturyLink has done, I can't make comments on that. But, those are all the elements, right, which go into as you are looking at these aspects.
Thank you, Gary. I'd like to go to our final polling question for the audience for participation. Compared to 2017, do you expect the number of publicly traded technology companies being taken private in 2018 to decrease, increase, et cetera? We'll take a few minutes to answer the question. Interesting one. Again, we're seeing some increasing slightly, which seems to be in line with the activity that's happening this year. So nothing surprising from my perspective, but I don't know, Ron, Veena, or Gary, if any of this surprises you.
It does not, to me. I think I believe it's going to increase slightly the privatization.
No, my only comment is the stronger the markets are, effectively the steeper the price of the take private, I guess, all other things being equal. But yeah,
that's a fair point. That's a fair point. Okay, I think we've got most of our answers. We'll move on to, we have just a couple more topics to discuss before we end. And so the next one, Veena, this is over to you, and I'd like you to talk a little bit about hyperscalers, how they're impacting legacy technology providers, and how they're forcing them to adapt to new models. And could you also just make sure that we're all on the same page in terms of how you're defining hyperscalers?
Sure. Yeah. Thanks, Richard. So hyperscalers is a term usually used to reference those companies that are like providing large-scale public clouds, enterprise-grade public clouds, if you will. AWS, Google Cloud, Azure is the second largest player today. Then there's Ali Cloud, and IBM is playing in this as well. But hyperscalers typically refers to the leaders in the pack, like AWS, Azure, and GCP, and Ali Cloud is getting there today. But basically, these are companies that are virtualizing IT infrastructure, if you will. So utility computing model, right? Enterprise customers can easily hire compute as they need it, storage as they need it, and network comes bundled with it. So they basically don't have to invest in the infrastructure or the hardware at all, and they can just leverage the infrastructure these hyperscalers have built and are providing. So I think it's fairly obvious that when it comes to IT infrastructure, hyperscalers are kind of on a mission to eat everybody's lunch, right? That being the situation, like not only are they providing compelling consumption models like pay-per-use, but they're also building an increasing number of services onto their platform, and they're bundling this for convenience and cost effectiveness as well. All of the cloud providers are also focusing on simplifying data migration from on-the-premise infrastructure to their own public cloud, sometimes even with physical appliances if that's the best way to do it. I mean, AWS has its Snowball and Snowmobile recently. Azure has, and this gets fairly deep, but Azure has a great strategy of this Azure Stack, which you can take and deploy in your private data center and create an Azure-like private cloud in your data center, which can then seamlessly migrate to the Azure public cloud, which is what they ultimately want. Google has built up a partnership with FedEx, again, to kind of help with this data migration from on-prem to cloud, because that was kind of becoming a bottleneck towards public cloud adoption. Bottom line is, in this backdrop, a traditional systems-focused approach is no longer viable as a strategy for the legacy infrastructure players. Consumer preference having shifted to paying for what they use as opposed to heavy upfront capex in IT infrastructure, the legacy vendors of yesterday are being forced to adapt by providing subscription-based consumption models and the best they can. Right? Some of them retrofit, some of them buy into this, and some of them are innovating into new lines of business. But end of the day, companies like NetApp that have successfully made this transition to meet their customers' changing preferences are being recognized accordingly by customers and also by Wall Street, and the stock price reflects this. So yes, I mean, valuation is impacted by whether a legacy player is able to transform themselves fast enough to still be perceived as a technology innovator, which is really where the investors or shareholders want to see companies going.
Thank you, Veena. And Gary, how about your perspective on the same question?
I think Veena covered it well, but maybe I'll, since we are all hearing about the three big ones, right? Amazon, AWS, Microsoft Azure, and Google. But think about, right, a decade back, Microsoft was one of those legacy tech providers, but they knew what they had to do, and they have transformed themselves. And I think it's critical that the companies have to adapt. And I go back to my slogan of Darwin's theory: you got to adapt, evolve, and survive. The legacy technology will be dead, and as a service model is going to be critical, and you have to leverage these providers as an infrastructure for your application workloads and get to the market faster. Like, even if I take CenturyLink as an example out here, we had acquired a company, Tier 3, which was in the public cloud space, but soon after we realized we can't be super competitive against some of these bigger players, and we ended up partnering in a deeper manner with these three providers. So to me, this is the future wave of how businesses have to transform themselves and leverage the hyperscale. And then, there are other elements which will kick in around the converged infrastructure, and Nutanix is a good example of how they are disrupting the space, which will be leveraged by the hyperscale providers as that technology matures as well.
Mm-hmm. Hey, Richard, could I just say something to close this out? I just one thing Gary mentioned, and then bring out the difference. He mentioned Microsoft and how they have adopted or rather adapted and built out Azure. But one thing to remember is Microsoft wasn't really in the enterprise hardware space. As long as you're in software, selling large enterprise applications is more lucrative, but it's not that hard to kind of pivot to selling it by subscription model. Whereas if you're a hardware provider, it's a much different ballgame. right? And I mean, we can see this with Cisco. They're having a lot of trouble changing their model to becoming software-defined network because you give up a lot of your premium products by doing that. So it's definitely a tougher battle. I think there is a distinction between how quickly the software side of the world adapts to this versus the hardware side. But they're going to have to get there. I mean, if you look at the three major hyperscalers, none of them have roots in enterprise hardware as their core business. So it was easier for them to kind of build that out. But yes, the hardware guys are having to catch up, and many of them are doing so.
Thank you, Beena. Well, we're coming to our last question, and I'd like to actually get everyone on the panel to participate. And so we'll start with Gary. But Gary, can you talk? I think we have about a minute or so each to answer. What trend do you think will be the most significant in reshaping the technology industry and driving future M&A? So Gary, why don't we start with you, and then Roger, and then Veena, you can have the last word on the topic.
Thank you, Richard. It's a pretty good discussion today, but I would say over the next decade and coming years, the automation, which is a combination of the AI, robotics, machine learning, is going to have the mega impact not only on the industry, but much bigger socioeconomic implications. We are seeing about the autonomous cars, and it's also very clear the 18-wheelers, right, 3 years from now, right, would be all automated. And the impact on the socioeconomic element is going to be huge, and how the workplaces would evolve would be very significant. So that's something we have to kind of have a pretty strong balancing act of how we adopt some of these elements. But that's going to drive a lot of the thinking of the corporations and how they think about the future and the acquisitions, the strategy. To me, that's going to be the biggest elements which will reshape our thinking and how the landscape is going to change.
Thanks, Gary. Roger?
Completely agree. I had that absolutely around all the AI, the machine learning, the automation. I think connectivity is important as well in terms of hyper trends around IoT and then the security ramifications and everything. What I would just say maybe as a closing comment is that while I agree that this will be pervasive and really drive significant R&D investment and all kinds of things, including deals as well, it will not, to my mind, necessarily be the major driver in terms of M&A per se. I think there are a lot of, from a purely M&A volume perspective, what hits the markets, a number of other factors which will sort of be driving that, including some of the less core activities of those companies we talked about earlier who are shedding, who are trying to be tomorrow's leader around everything Gary described, but who actually shed more legacy or traditional activities in that process.
Excellent. Thank you, Roger. And Veena, you have the last word, and not just because you and I share an alma mater, but because we appreciate that. So over to you.
Thanks, Richard. So it's nice to end a discussion that's had some debate on a kind of well-aligned note. So I think let me just, before I get into the technology that I think is going to impact us most, say that like in the here and now, it's clearly the migration to public cloud that's causing the most disruption, at least in the enterprise world. While for consumers, it's still about mobile and the interactive web and how that's changing their lives, or especially their social lives. But in the long run, I also completely agree that it's AI that will change the way we live and work the most. I mean, well, that might not be for another 10 years. I believe intelligent machines will touch and kind of even run most aspects of our lives in the not so distant future. So we are in unison on that. But I do agree to some extent with what Roger was saying, that at least in the next 2 years, this is not probably the driver of the larger M&A deals. It might be, however, the driver of volume as companies try to bring in technology talent. Like this is going to be the major vehicle for acqui-hires, where you're trying to bring in this cutting-edge AI knowledge and this team of specialized people into your company to help and grow that aspect of your own technology. But probably not very large-scale acquisitions in the very near future.
Maybe, Richard, just to add, guys, maybe my view is the automation is coming at a much faster pace, and there are two schools of thoughts. I am predicting, I think this is going to be, it is at our doorsteps, and it's going to be, the pace is going to be increasing. You're looking at 3 to 4 year window, not 10 years. And so this will surprise everybody, but I've been talks with a lot of the universities about this, and there is a big concern in some of the largest corporations, and there's a lot of studies going on because the socioeconomic implication and how the workplaces will change is significant. And so I'm predicting a 3 year window versus 10 years on this place.
So since Richard promised me the last word, let's just, I'll only say let's all touch base on 3 years and see how much it's transformed. It's definitely going to be making inroads, but I think transformation will take some time.
Excellent. We've come to the end of our session, and I'd like to first thank our speakers today for taking their time to share their expertise and their perspectives on these interesting topics. I'd also like to thank our audience for taking their time to listen and be part of the conversation. We received quite a few questions on the Q&A sections, which we don't have time to answer. However, we promise to compile them and get back to you with those questions, and we'll certainly work with our panelists to answer those questions. And so here, I'm going to end the webinar. Thank you very much for attending, and have a great day.